In our last video, we had introduced beta in the security market line, and we had walked through an example of calculating beta for Google and Caterpillar based on the last 5 years of information from the financial markets. Now we're going to use that beta to calculate the required return using the security market line. And we're going to talk a little bit about what that means. So we're going to get a required return for Google, a required return for Caterpillar, and we're going to talk about what those mean. So we calculated our betas previously. The beta for Google was 1.10, beta for Caterpillar was 1.91, and now we want to use those to calculate the required returns. Back to the security market line, and we can see the required return is equal to the risk-free rate plus beta times the expected return on the market minus the risk-free rate. So the first thing we need is the risk-free rate. And in our example, we assumed a risk-free rate of 3.8%. That was the 10-year Treasury note yield at the time I recorded this video. And our expected return on the market was 10%. Which is just an estimate that I used. Historically, stocks have earned about a 9 to 11% rate of return, and so I just used a 10%, kind of split the difference rate of return for the market in our example. So now we start. The required return for Google is equal to the risk-free rate, which in our example we said was 3.8%, plus beta. Beta for Google, remember, we said was 1.1 for the beta for Google. The expected return on the market, we said was 10%. And again, the risk-free rate, 3.8%. Now in doing this, you want to be careful of your order of operations. Do what's within parentheses first, multiply by beta, add the risk-free rate. So 6.2 is our 10 minus 3.8% times 1.1 plus 3.8. Gives us a required return of 10.62%. So in order to invest in Google stock, we want to earn at least a 10.62% rate of return. Do the same thing for Caterpillar. Again, the risk-free rate is 3.8%. Our beta for Caterpillar was 1.91. Expected return on the market, 10%. Risk-free rate at 3.8%. So again, go through the calculations. 10 minus 3.8 times the beta. Add in the risk-free rate, and we get a required return of 15.64%. Now there's two ways we can use that required return. One is we can calculate the expected return using the formulas that we did earlier for each stock, come up with a probability distribution, calculate the expected return, and compare it to the required. For example, if we came up with an expected return on Google of 13%, we would want to buy that stock because it has a required return of 10.62. That's less than the expected return. So we expect to earn more than we need to compensate us for the risk. If we had a required return on, or if we had an expected return on Google of 8%, we would not want to buy that stock. The expected return is not high enough to compensate us for the risk. We need at least 10.62 in order to buy that stock. A couple of last things I want to comment on real quick. One is, notice that the only difference between these two equations is the beta is different for each company. The expected return on the market and risk-free rate will be the same. So high beta stocks have a higher required return than low beta stocks. Another thing to point out is that if we look at the standard deviations, we see that Google actually has a slightly higher standard deviation than Caterpillar. By itself, Google is a riskier stock. However, as part of a portfolio, Caterpillar is a lot riskier stock. So some cases, stocks that are riskier by themselves may be less risky as part of an overall portfolio. The last thing I want to comment on is kind of tying this into Chapter 6 on stocks and stock valuation. If you remember, we had a formula in Chapter 6 for constant growth saying that the price of stock was equal to the year one dividend divided by the required return minus the growth rate. This required return, which was always just a given in Chapter 6, is now something that we can estimate using the security market line. So the required return for Google is just 10.62, so that's what we're going to plug in there. If Google had a dividend of $3 in year one, a growth rate of 4%, then we could calculate the price as $3 divided by 0.1062 minus 0.04 to figure out what that's worth. Running through those numbers real quick on the calculator. $3 divided by 0.062 gives us a value of $48.38. Now, this does not work for Google because Google is not a constant growth stock, so that number is not very meaningful. But if we did have a constant growth stock, this is how we could use that required return and plug it in to get the value of our stock, find out what it's worth.